First of all, thank you for coming, joining us here today. Thank you very much. Yes, it's okay to get excited. As you know, you're in the Opportunity Zone panel room. We think this should be the most exciting thing that goes on today. At least I'm going to claim it. We want to get started off. I'm happily joined by Reilly. She's with the Economic Innovation Group. You'll hear from her today. They're kind of like we're on the forefront of this whole Opportunity Zone policy. Morial is the president of the National Urban League. They do great things in the community. And then we have Ben Hobbs with us. He's with the White House Domestic Policy Council. So they're kind of charged with doing the whole presidential order on the White House executive order for the Opportunity Zones. Just give you start with some facts. 52 million Americans live in distressed communities, 52 million. And despite the growing economy, and the economy is growing at historic rates, people in these economies still face, high levels of poverty, high levels of unemployment, failing schools. So because of that, the president in December 2017 signed the Tax Cuts and Jobs Act, which created the Opportunity Zones. And the Opportunity Zones is basically a new tax incentive that promotes long-term equity investment in low-income communities designated as qualified opportunity zones. And just some opportunity zone facts, there's nearly 35 million Americans that live in opportunity zones. Unemployment rates are 1.6 times higher in opportunity zones than other communities. Median family income in opportunity zones are 37% lower than their areas or states median. And the average poverty rate across opportunity zones is more than 32%. That's almost double the average percentage rate. So as you can tell, everybody on this stage has a big heart. Some of us come from small towns. Some of us come from high metropolitan areas. And we want to fix and we want to make sure that no communities and no Americans get left behind in this economic boom. So the Opportunity Zones project is a great way for investors and people looking for investments to grow and scale their businesses can come together and we can start seeing some rebirth in some of our great American cities. So with that, I'm going to hand it off to Rachel to kind of give a background of what you do at EIG and just some personal why this is so important to you.
Yeah, thank you so much, and thanks everyone for having me. Reilly with the Economic Innovation Group. We are the bipartisan policy think tank that was the lead advocate behind Opportunity Zones. And just a little bit of background on us, we have developed different policy ideas, data-driven policy ideas, to really empower investors and entrepreneurs throughout the nation to help forge a more dynamic American economy. And so when we look at Opportunity Zones, what we see are communities that definitely have the potential, entrepreneurs that have the potential in these communities, but have just been overlooked by the traditional capital markets and by investors for so long because investment decision making is concentrated, right? You're concerned as investors around perceived risk or actual risk, so risk is a factor, as well as ease of execution. So if it's easier for you to put money in products that you know of, that you're used to diligencing and underwriting, and it's familiar to you, there's a real scale around ease of execution. And so because of that, because decision making has been concentrated amongst private wealth managers, sometimes there needs to be incentive for capital to flow elsewhere because capital then also gets concentrated. And by elsewhere, I mean into places and people and products that are creditworthy, but just are not within these existing networks or the product doesn't currently exist. And so what's really exciting about Opportunity Zones is that at the same time we're standing up a federal law, states are also coming to the table with new incentives to attract investors to help support these businesses in these places by getting capital where it's needed most. But we're also standing up a new investment market, a new asset class for community investing. And so my background has been in impact investing, which I can tell you for the past decade has meant a lot of pounding the pavement, trying to convince high net worth individuals, foundations, and businesses why they should care about where their money goes. I've never seen so much interest in investing in distressed communities as I have since this has been passed in late 2017. And with that interest comes general concern sometimes around what types of investments are allowed, but also a huge amount of potential. And so with opportunity zones, why I care is because I truly believe that where you live, where you grow up, the amount of investment you see in those communities has a direct effect on how you think people view whether or not you are investable or whether you're worth investing in. And it has an effect on how you view your potential in the world. And so as we have this new incentive that investors are demanding their wealth managers to find product, and by product I mean opportunity funds, and I'll get into the mechanics of that, as we have this new incentive that is really creating this demand for new products and to find investable deals, we're seeing this new market generate, and we're seeing people become really creative around the different structures that they want to see with opportunity funds. And so it's what I think is, there's this big question, and maybe it's going off point a little bit, but a big question about whether or not capitalism is broken, and I think capitalism maybe has just gotten a little lazy, and this is the incentive that's put a lot of folks back at the gym, maybe like couch to capitalism, park. Okay, awesome. 4 o'clock, got some laughs.
Yes.
Got some laughs from the White House. Going well. Okay, so with that, what I just want to share is just a general structure around opportunity zones. So you sell a bond, you sell property, you have an event where a capital gain is potentially triggered. You have 180 days to decide whether or not you want to realize that tax liability in that taxable year, or find a new investment vehicle called an opportunity fund that was authorized through tax reform to then place your capital in. Opportunity funds by statute are very flexible. There's really 3 requirements. 1, you have to be organized as a corporation or a partnership. The second requirement is that you have to be organized for the intent of moving eligible gains into opportunity zones, and that your organizing documents have to state that. And the third is that you have to have 90% of your assets deployed into opportunity zones. And opportunity zones are census tracts that were chosen by governors at the beginning of last year. And so all of a sudden we have this investment mechanism to flow investment dollars into distressed communities. And we, to some extent, have some proposed regulations out, 2 rounds of proposed regulations. We'll probably have a final rule by the end of this year that will help investors start to make decisions around how they want to move capital. So in saying that, I will say from my seat, I am seeing a lot of new ideas, a lot of excellent ways that this money can be invested. And I'm also seeing cities rethink their economic development strategies as well. In Birmingham, Alabama, Birmingham has got an outsized amount of attention for the innovative work that they've done around opportunity zones thus far, because they really had local leadership take this by I guess, I don't know, take it by something, and they ran with it. And so they just got a $24 million investment to revitalize a vacant building that had been empty for 36 years. And PNC Bank is making an investment alongside some additional historic tax credits, some blended finance provided by the city of Birmingham. But this is going to be new workforce housing for the city of Birmingham with some set-aside units for a local nonprofit. And that's sort of the revitalization that I think is going to really move this forward and help more creative thinkers problem solve in their community. And yeah, I think that's the potential for opportunity zones.
Great. Before I hand it off to Marc, by a show of hands, how many of you have potential capital gains liability? Okay. So now, that's all right.
How many of you know people with this?
So great. So that was a very great breakdown of some of the mechanics of opportunity zones. How do you create a fund and why it's so important? another great component of this is the community, right? And we want to make sure the whole reason for the policy is to make sure there's some inclusive growth in these communities. And I know nobody better than Marc Morial to talk about some of the connectedness in communities and how to generate opportunities.
Thank you, Henry. And first of all, good afternoon. I'm really proud to be here today. I'm Marc Morial. I lead the National Urban League. The National Urban League is one of the nation's largest and oldest historic civil rights and urban advocacy organizations. We operate in 36 states, 90 communities across the nation. We do community development. We provide job training, after-school services, home buyer education services, entrepreneurship services to over 1.7 million people each and every year. We're also an advocacy organization, and to that end, we're strong supporters of the Opportunity Zone program, which actually had its genesis in a bipartisan bill introduced by Senators Tim Scott and Cory Booker. And Tim Scott, give him all of the credit for, if you will, leveraging the Opportunity Zone bill into the big tax cut legislation. I also previously served 8 years as mayor of New Orleans, my beloved hometown, and president of the United States Conference of Mayors. And I wanted to create that perspective because the Opportunity Zone program is part of a continuum of thinking around urban development called place-based strategies. All the way back in the 1980s, the late Jack Kemp, along with Charles Rangel, introduced the first enterprise zone legislation, which was a novel idea to create tax incentives for investments in urban communities. What followed that was state legislation, which mirrored that approach. Which followed that was the Clinton-era empowerment zone programs, which married both tax incentives along with federal direct investment, along with a requirement that cities that were designated as empowerment zone communities or rural areas have strategic plans around that. This legislation, the Opportunity Zone legislation, is in that same genre because it is about creating incentives for focused place-based investment. Now, there are 8,700 qualified opportunity zones in the United States. 40% of them are rural, 40% of them are urban, about 20% of them are suburban. The opportunities, the potential, and the promise for this piece of legislation is enormous. And then there's some cautionary tales, cautionary notes that I want to talk about a little bit. But let me paint a picture for people because we talk about these distressed communities. But I would say to you that distressed communities in the United States represent the highest potential emerging markets in the world. I don't look at these communities as glasses half empty. I look at them as glasses half full. Let me give you some numbers. And I'll talk about communities of color. If you take the spending power of African Americans, Latinos, and Asians, and match it here in the United States where we have a 19 or $20 trillion economy, it represents almost 4.5 to 5 trillion in spending. Well, what does that represent? That's 3 times as large as the economy of the Russian Federation. It's larger than the economy of almost most countries except the leading industrial nations, the United States, China, the UK, Japan, maybe France in the world. That's the marketplace, which now in the United States represents over 100 million and almost 5 trillion in spending. That's a significant marketplace. It's a consumer marketplace. It's a marketplace of investors. It's a marketplace of enormous potential. So when one thinks about distressed communities in the United States, I would hope that people would think about it as areas of great economic potential that for too long we have stereotyped, we have ignored. And to the extent that this is going to create a new look by the investor community, by the private investor community in these communities, the potential is indeed enormous. what do we want to see? We want to make sure that what this legislation incentivizes are investments that are going to benefit these distressed communities and not displace people in these distressed communities. And that's going to require responsibility on the part of investors. It's going to require a good regulatory framework that encourages that. It's going to require the leadership of mayors, city council members, county council members, governors and state legislatures to make sure and to ensure that the kind of projects that, that this program creates are going to benefit these overall communities. I have encouraged mayors, I've encouraged my own local leaders to suggest, and you mentioned the Birmingham example, which is a great example, every local community needs to have a strategy. Yeah. Needs to have a strategy, needs to have a task force, needs to have a working group, and that working group should be a place where the investors, the public and private sector can sit at the table together and envision how the Opportunity Zone program can benefit that community. Because communities are alike, but they're very different. And the vision here was that this program be an urban, suburban, and rural program, which is smart because areas of distress and economic distress in this country today run the gamut. Big cities, medium-sized cities, small towns, aging suburban neighborhoods, rural communities where people have been displaced from, all the way along the line. So, you know, we're looking forward to working with you. And to the extent that you all represent investors or influence public policy, what is the most important thing? This is not a self-executing initiative. This is really a door of opportunity. And it's very necessitous that communities, whether it's a city or a county or a state or economic development agencies, have good plans around how it's going to benefit. Those plans have to be put together by, thank you, by the private sector working in conjunction with the public sector. And I look forward to discussing this more, but we're excited about the opportunity, but we've also got to hold up the caution flag around this so that this does not become an avenue or a mechanism for displacement, but a mechanism for true rebuilding and revitalization of communities.
Yeah, thank you, Marc. I think that's great. And speaking of plans, one of the things that we noticed very early on, well, it's not noticed what it is that the Opportunity Zone legislation is a private sector tool. It was meant for the private sector. But we also know that in order to sometimes, as Rachel mentioned, to get capital to do things it normally doesn't do, you have to have some capacity building. And I thought it was great that the White House took on very early on, how can we make sure, how can we kind of get capital directed to areas that it normally doesn't go or that some people need more information on? So Ben, do you want to talk about some of the work of the White House Opportunity Reserve Council?
Absolutely. Thank you for having us here, and thank you, Marc, for that great sales pitch as well, and Rachel covering some of the details. So, why Opportunity Zones is important for me. I'll start off by saying that my hometown, a small town of 15,000 people in rural southeast Ohio, is an Opportunity Zone. So, you know, growing up, I saw firsthand the decay that was happening. You know, when you say a word of venture capital in my small town of Alliance, Ohio, you know, you'll turn heads of what is that? I've never heard of that before. And so we're lucky enough to have that designation. So every single day it's a treat to get to come to work at the White House and spend so much time on this important initiative and know that my hometown could very well be a significant beneficiary of this. So, you know, to that point, I guess I'd say we kind of have I'm wearing three different objectives in the White House. First and foremost, as Rachel talked about, is implementing regulations, getting those out the door. So of course we've had our first 2 tranches of the proposed rule. There will be a 3rd tranche of the proposed rule. That'll be coming out later this year, and all that's going to consist of, and all that is reporting and non-compliance. So the first 2 tranches of rule, we believe, have everything out there necessary for deals to be executed. And that was the goal, is to get those rolled out as soon as possible. Those are still in comment period, or at least the second rule is. So, you know, if you've had a look at those, or I invite you to take a look at those and submit comments through the official manner through the IRS or the Treasury Department. We're definitely taking those into consideration, and we want to make sure that the final rule, that hopefully then will, like Rachel said, come out towards the end of this year, cements and finalizes everything in the most equitable way, and also so that this can attract capital in a wide array of businesses and opportunities. And that's one thing I'd say is a strength of this as well, is you can be an opportunity investor, an opportunity zone business in real estate, in mining, in energy, in services, technology. It runs the gamut. There is no regulation in statute or regulations prohibiting any of those industries. I'll go in a little bit detail and kind of pick up where Rachel left off. The first benefit of opportunity zone investments is, of course, the time value of money. If you have a capital gains liability in 2019, so you sell some property in the United States, or you sell some stocks, or what have you, or a business, you can defer paying that by investing in a qualified opportunity fund until 2026. That's the first benefit. The second benefit, if you hold that investment for 5 years in a qualified opportunity fund, you'll get a 10% basis step up, or basically a 10% reduction on that tax bill when that comes due, of course, in 2024, if you pay then. If you hold that investment for 7 years, so now we're at 2026, you get a 15% reduction on that tax bill. But then the big benefit comes if you hold that investment for a full 10 years, any added gains, so let's say your initial investment was $100,000. Of course, then you're going to have to pay your 15% reduced tax bill on that in 2026. But if you hold that to 2029, then, and it doubles in value, the business you invested in, now your stake is actually worth $200,000. That additional $100,000 gain, you can have free and clear with no tax liability in 2029. That's the big time investment. And the reason this tax incentive is structured that way, to Marc's point, is we wanted to make sure that investors stay invested in the communities that they're engaged with. This isn't an incentive where you build a building and run away. You start a business and walk away. This is something where your value, your returns on your investment will be greatest if you're involved in the community, you're helping uplift the rest of the community, developing that ecosystem so all those businesses are benefiting, so you're getting a higher return on your investment. So to Henry's point, that's how we're incentivizing the private sector here. So to what Henry was talking about, we have this private incentive. Well, we also realize that we can't just set up this tax law and walk away. We also need to educate the public on this paradigm shift and what this is, and we need to have a public sector commitment for some public sector capital to come in. So on the first point, this is a paradigm shift. This is the most aggressive place-based policy, but it isn't another grant program. Nobody in this room, no small business, is going to write a grant application to the Department of Housing and Urban Development or the Department of Treasury, hold out their hands and hope that they get chosen. This isn't another government loan program either, that has limited resources. There's, $6.1 trillion of unrealized gains, capital gains in the United States that could potentially roll into opportunity zones. So for the first time, a lot of businesses and a lot of community leaders, instead of coming to DC and asking for permission or asking for guidance and help on doing this, they actually need to be working with places that have venture capital, Lower Manhattan, the Bay Area, or their investors in their hometown community. And that's one big untapped market as well, is who are the wealthy folks that have capital gains liabilities in their community that they can connect with. So the first goal of the White House Opportunity Revitalization Council that was created by the executive order the president signed back in December is to help educate, to bring the tools and the know-how, and to do things just like this panel and work with groups just like EIG and the Urban League to educate and bring that knowledge into the public, both for the small business owners, the community leaders, and the investors we're talking to here today. The second goal of the White House Opportunity and Revitalization Council is to take existing federal programs and target, streamline, and coordinate them to opportunity zones. And this is the understanding that we have, again, that we can't just create this tax incentive and walk away. A lot of these communities, suffer from lack of infrastructure. Some of them suffer from lack of workforce and education training. Some of them are suffering from entrepreneurship development. Some of them need assistance in safe neighborhoods. One of the big drawbacks and folks that we learned from the Enterprise Zone program was investors weren't willing to go into communities if they couldn't count on that community being safe. So we've worked now with 16 different federal agencies. We've identified 160 of their programs. These are loan programs, these are grant programs, these are insurance programs to help target and bring those resources to the maximum extent that we can towards opportunity zones. We've completed that action on 100 of the 160 at this point, and we're hoping by the end of the year, of course, to ramp that up all the way to 160. These are things like, as I mentioned, transportation, competitive transportation grants from DOT, workforce training grants from Department of Labor. The Department of Education is undergoing rulemaking to change their criteria for charter school grants to target them at opportunity zones. The Small Business Administration is working a lot on their government contracting. The Economic Development Agency at the Department of Commerce. Any project in an opportunity zone immediately qualifies for that consideration. So these are all different efforts. HUD has recently cut FHA insurance fees for opportunity zone finance projects. So it's a wide array across all different agencies and industries of how we're bringing additional resources into opportunity zones. So,
Great.
Yeah.
I guess I'll end it there.
Okay.
I'll turn it back over to Henry.
No, that's great. One of the things I've noticed, and I've been traveling across the country on opportunity zones, is almost two trains going opposite directions in the middle of the night, right? So you have the investor community and the tax lawyers who pretty much know what this is, right? They know the rules and the regs, they'll weigh it again. But there's also the communities that these investments take place in, which is what Marc is talking about. So Rachel, I know EIG is working on this. What more do you think can be done to connect some of these investors with, people in communities looking for investment and to get the word out? I mean, this is a start, but obviously everybody can't come to panels and summits like this.
Yeah, I spent an entire year of my life thus far, year plus, on panels crisscrossing the nation. So I'm also seeing the same exact scenario where you have the traditional capital markets and their lawyers and accountants, and then you have the communities in which this investment needs to be deployed. And again, as having a background in impact investing, that was the same dynamic where you had these two very different, in most cases, stakeholder groups and no connective tissue or shared language around what it means to work together. So for example, you go to the traditional community development sector, you talk about equity. They think, equitable, right? They think equitable, inclusive. Sometimes they even think grants. Sometimes the community development sector thinks about equity as in grants. You go to the capital markets, equity means something completely different. And so just having a moment to collect and gather different stakeholder groups in the same room, because everyone needs information at the same time, has been an opportunity to have some of those cross-sector conversations. And what we need is more of that, and we need to ramp that up. And really, it's a capacity building issue at the community level, and so the work that Ben and his team are doing at the White House in providing grants to help support that, a lot of what foundations are doing. So Rockefeller Foundation just announced a $5.5 million grant to support 6 communities in helping to build that capacity. That's really what's needed. And so for this room, I saw a singular hand around gains liability, capital gains liability. Two hands. Okay, so one out of my periphery. But what I would say is that even if you don't have gains liability, I would take a look at these opportunity zones because that's where investment is going to be targeted over the coming years. The way the census tracts were chosen was that you had a number of eligible low-income communities, and governors had to basically reduce that to 25%. So of all the eligible communities that could have been designated as qualified investment opportunities, only 25% of those were chosen, and that was an initiative to concentrate capital in the same communities, the same locations. And so that's where I would be looking for investment opportunities and working with the local governments to figure out what their opportunity zone framework is, and their strategy is to align your investment dollars with what the local community is thinking. And just want to really underscore that, you know, there's funds that I've seen. Right now there's $29 billion in capital raises happening right now. 134 funds have launched or have opportunity zone. Yeah, so one of the things is that you self-certify. And so actually it's unknowable at this point how many opportunity. Yeah. But there's a registry at this moment where if you want to raise your hand and say, we are certified, self-certified as an opportunity fund, we are raising capital, there's some directories you can go to. And one of the directories out there is saying it's a $29 billion in aggregate fundraise effort across 134 different funds across the nation right now. And so just to size the market right now before the final rule has been completed, that's the interest level at this moment for these distressed communities and domestic emerging markets, as some folks call them. Yeah.
Yeah, no, that's great. And I'm glad you mentioned local and state because it is a federal tax incentive. And Marc, you mentioned you used to be a mayor of New Orleans, and you also mentioned the importance of communities stepping up with a plan. Opportunity zones is one of the things where you have to go out and you have to be ambitious and you have to find the right tools for your people. So can you just talk about how to like strengthen?
A lot of these projects end up being put together with mixed financings anyway. So you usually in urban communities, you'll see projects being done with a combination of tax incentives, loan guarantees, equity capital. That's the formula for lots of development in urban communities. And I've found that in my experiences is that the city government was at the apex of most of these projects because of the need to assemble all of the factors. There was zoning, there was community engagement that had to be managed. There was, in some instances, state funds or state incentives, local incentives, all tied together. So the smart community developers or the smart developers understood how to tie all those pieces together. And this is yet another piece that's going to be available. One thing we really, I'm sitting here saying, thinking about some of the challenges you've addressed, some of the opportunities that you've talked about, and there really needs to be a set of regional conferences that bring together local elected officials, community development people, along with those who have created funds, to learn more about the mechanisms of how all of this plays out. I think that is absolutely essential. I think what we're going to also see is major financial services firms are going to create labeled funds, right? And so an ecosystem will develop where if you have a project, once there's a registry and people will be able to go and knock on the door of a fund here or a fund there when they have a project that is available for financing. I'm hopeful that what you mentioned in Birmingham gets a lot of attention.
We're trying.
Because a couple of successes early on, high-profile successes that generate a lot of attention are going to show people a little bit more of the way. I think that like anything that's new, there's a sense of uncertainty around it. There's a sense of assessment of risk around it. And so people kind of want to see somebody do it first. and then there'll be thousands and thousands of copycats. That's the way we get things done in this country. But local governments, I think, are very key to this. And I'm talking about not just mayors, but I'm talking about county officials. A lot of these rural areas, it's the county government that is of paramount importance. And so you've got to bring them to the table. You've got to bring the mayors to the table to learn about the opportunity and learn about the mechanism. So this is, an evolving opportunity. I mean, for those of you that, are maybe foreign investors in the United States, one thing we want to keep in mind is that the Opportunity Zone is going to create, in some instances, for some of these projects, this sort of last mile of financing, potentially, right? And so that means that even if you're not a person or a developer or an investor who is directly interested in or who can take advantage of it, you want to know about this because it's just another opportunity to raise money for these directed projects in these opportunity zones, so, which is why the entire ecosystem, is going to have to learn about how this works and what the real chances are.
Okay, I'm gonna ask one more question, Ben. Then I'm gonna open it up for some questions.
I think so.
Ben, now what do you say to people who say, you know what, we know about these place-based initiatives, been to them before. Why'd you create a council? Sounds like another layer of bureaucracy. So can you talk about how, this is different? I mean, we already talked about just a vast amount of the map that's covered, 8,760 opportunity zones. That's huge. And the importance of the council having these departments making decisions together in real time. So SBA is not trying to solve a problem that the Department of Commerce is trying to solve. But the fact that they can work together and make a bigger impact, or to some of these cross-cutting things that they're doing. So we just talk about how this is different, how the council is supposed to work to generate some opportunities in these areas.
Yeah, absolutely. And then we talked a little bit about them. So yes, 12% of the United States is in an opportunity zone. I'd say the first thing that I think is different about this, when we look at some of the past place-based initiatives and how they came about, they're really on the demand side, and they're very firm specific. Enterprise zones, for one, of course, offered specific tax credits for businesses to locate themselves in enterprise zones. Well, what we saw that happened from that is a business that was just outside the zone would pick up, move their operations inside the zone, get all the tax benefit from the federal government, the taxpayers would pay all that extra money, and there'd be no net job gain. Or there'd be no gross net. There would be a net zero for the entire community. All you're doing is just moving, shifting around resources, and then there's a lot of opportunity costs, let alone in that. What Opportunity Zones recognizes, it's a supply side. So it sets up the situation where we've lowered the capital gains tax down to zero. For investors that bring their money into this zone, but it's also for new investment. The property has to be purchased or put into place after December 31st, 2017. So you're not necessarily going to see the shifting of existing businesses leaving their current areas and moving into zones. This is an effort to create new ecosystems, new economic development, new tech startups or energy startups or what have you in areas that never existed. And to help turbocharge, some of the businesses that are there. So it really is. It's a unique incentive, and like I said before, too, it's not a government program. The joys, the benefits and the curses, if you will. So some people are upset because you don't have to come to the federal government to start a zone. Anybody in this room tomorrow that has any stock in the U.S. stock market or property in the United States can sell that and start up an Opportunity Zone fund on your own. And we wouldn't know about it until you file your taxes. And that's actually a good thing because we don't want to hold you up on making those investments and taking that leap by filing paperwork or anything like that with the federal government. So That is a big benefit, I think. And, we are working on, some of the reporting pieces because it is very, very important that we know and can measure successes in this program, because we want to make sure that we did learn from some mistakes of past place-based initiatives. We want to make sure that this one fulfills its promise. So that's very important. For the council, a piece I'd say there is, we're certainly working across all 16 different agencies. One key initiative that we're working on is some field manual trainings, because we know all these agencies have field staff. Commerce has field, MBDA has field staff, the Small Business Administration has field staff, USDA has field staff, Housing and Urban Development has field staff, all Health and Human Services. So how can we train that field staff so that they can host roundtables just like this in every community across the country, be they rural or urban or suburban? So one of our key initiatives that we're working across agencies is to train all those field staff. And letting them each know. So when SBA is hosting a roundtable, in Rhode Island, they can speak to and have with them, here are all the housing programs that Housing and Urban Development has that might be useful for this community. Oh, well, if you're rural, here's all the USDA pieces. And having that at your fingertips. So that's something that we're publishing. The council is also developing opportunityzones.gov. We haven't launched yet. It's coming. The government is sometimes okay at websites. We don't have a great track record, but we're hoping we can correct that. But it'll be a one-stop shop where investors can go and learn, how does this incentive work for them? Why do they need to be thinking about opportunity zones? A place where businesses and entrepreneurs have ideas, where they can go and learn what do they need to do in order to get that opportunity zone investment. And a place where local leaders can go and they can think about what is going to be their local strategy? What are the prospectus guides that they need to be developing to attract investors? What are all the different programs across all the agencies that they can tap into? Instead of a mayor having to go to the Commerce's website and then SBA's website and then trying to figure out HUD's website on finding these resources, having them all in one place where people know where they can go. So those are a few different places that we're working together across all agencies.
Thank you. That's fantastic. We have mics set up strategically across the room, so I ask that you line up behind the mic and we'll take some questions.
Hi, should I start?
I think we're starting over here, if his mic is live.
Okay,
Yeah,
Peter Summer,
All right, so
Capital
we'll go with you.
Intelligence Group. I have a news media company. I have a news service called Black Business News, which looks and focuses on every opportunity zone. I didn't know it was only 12%. That 12% is where you want to invest in America, the largest economy in the world. And Mayor Morial, we shouldn't call it emerging market. I don't like the term because those in the market don't like it. I call it early growth markets. These are markets that are going to grow for the next 10, 15 years. Anybody looking to invest in America, if you're not in an opportunity zone, you're going to lose your shirt. This is where the growth is. This is where the brain power, Memphis, Baltimore. I mean, if you look at I'm a native Washingtonian. You look at Washington, D.C., we're booming. The next fintech center of high tech is going to be Anacostia, east of the river. Everybody's going to be seeing Microsoft. Everybody's going to be there. That's the future. My question is, the Opportunity Zone gives a great opportunity for those who bring value added. We have the head of Generali who wants to use it. We have the Qatar Investment Authority, which already did Center City here right next door. These people bring value added. These are good investors. The problem is bad money, bad investors often squeeze out good money, good investors. In D.C., we're fighting a condo in the Brooklyn neighborhood, 80%, the most affluent, most important black American neighborhood in the country, and we're fighting a crappy Florida developer who's building a stupid condo for millennial suburbanites, blocking one of the great art pieces of, cultural heritage, and, just basically aggression on our neighborhood. How can we welcome the good investors and make sure those who do not bring value cannot get the tax break and can't even con people to give them money, because we see a lot of bad opportunity zone funds going around, saying, give us money, you get tax-free, run by people that I wouldn't even give my dog to, whatever, or I wouldn't give it. So how do we do in the government that these people should know that they cannot come into the neighborhood because they don't bring value? They won't even get the tax break because they'll never make money. And those who do, who bring jobs and transformation, how do we get those people in?
I both got very excited, and then my level of anxiety spiked, and
Yeah.
it was like a roller coaster during your entire question. But you're totally right. I mean, this is where the growth is going to happen. That is very encouraging, because it's where they haven't seen, these communities haven't seen investment in decades. They've been left behind post-recession as far as investment goes. But at the same time, it begs the question, how are we ensuring that the businesses and residents that have lived in those communities for decades can benefit from the investment that's coming in, and they're not displaced? And I think that goes a little bit to Ben's point around the third round, or the third tranche of regs that are coming out, so the anti-compliance and abuse measures that we're hoping to see, as well as legislation that was introduced by Senators Booker and Scott in, I guess it was last month, around investment transparency and reporting requirements, which are not part of the original statute, were always part of the originally conceived concept of opportunity zones. So that legislation is looking to put those measures back into statute or into implementation through the regulatory process. So we understand, and it's made publicly knowable, how investments are impacting communities. And I think it's part of my job at EIG to be elevating some of these best practices that we're seeing around the nation for equitable investing and for investing in communities that really live up to the true intent of opportunity zones. And so when I say it's my job, that means I've been working with first movers throughout the nation, and will continue to do so, to help figure out, as they move forward in Birmingham, in Miami, in Utah, throughout the nation where we're seeing success, what is the secret sauce? What has made them successful, and how can we be taking those best practices, elevating them throughout the nation so that other communities can copycat off of that work? And Ben said something earlier. He mentioned a prospectus, which we haven't covered yet, but a number of cities at this point, so 30 cities throughout the nation, have identified their investable assets, so what the projects are where they want investors to be diligencing first, to be looking at first. And so 30 cities so far. I think it's going to be up to 50 by the end of the year. But for example, in Louisville, Kentucky, there's a site that the Urban League in Louisville owns. And in their prospectus in Louisville, they have elevated that as one of the investable assets where they want to see investors come in with opportunity zones to help work with the Urban League to redevelop that site into a sports complex, which is going to generate economic activity. It's going to grow the tax base. It's going to be really catalytic for that community.
Let me just add the following. Ideally, there should be some sort of regulatory framework that's not overly burdensome, which sets up some guardrails about how these projects operate. In a practical point of view, putting my hat on as a mayor, I control zoning and I control permitting.
Yeah.
And therefore, if you're going to do, most of these projects require conditional uses, zoning waivers, zoning adjustments, and I wouldn't agree to anything, finance anyway, unless I thought it was in the best interest of the city. In some instances, you control permitting. In some instances, a developer walks in and says, now, I want to do this project, but I need that piece of city land, and I need it for $1 a year for 99 years, or I need it for $1 a year for 10 years. Or, by the way, you've got a restoration tax abatement program. I need that in addition to the opportunity zone financing. Or I need the opportunity zone financing, low-income housing tax credits, the restoration tax abatement program, and I need some public dollars to make infrastructure improvements around the area so that my business works. So in reality, local government's going to have a little leverage in the process along the way to get these projects done. And if it's used skillfully, if it's used reasonably, and if it's used responsibly, you get the kind of results you need to. Doing business in urban communities requires public-private community partnerships, period, right? And I've seen lots of people with great ideas get jammed badly because they don't go talk to the community. Yeah. They don't go talk to elected officials until after the fact. I woke up one morning in 2001 and learned that the owner of the New Orleans Saints wanted to demolish a public housing development to put a new stadium. Of course, that stadium never got built. That project never went anywhere. Mm-hmm. The point is that you don't announce a major project that displaces thousands of people without giving heads up to elected officials or go and talk to community people and say, you know what, you will be displaced, but we will relocate you, and here's the plan to relocate you, and et cetera, et cetera. So this requires really an understanding of how community development works. I think that to the extent that, let's presuppose major institutions like banking institutions create opportunity funds. Lots of them have some experiences because of the Community Reinvestment Act and their branches in doing business in cities in this sort of way. So again, this is a great opportunity with the need for caution and guardrails. And the reason why I think early successes are necessary is because you get one bad example and then people run away from a good idea because they see how. And so, my appeal to those that are going to set up these funds is not look at this as a fast money deal, as a lottery of some sort, but as something that really has a double bottom line advantage.
That's great.
So first of all, I want to let you know that this is a great program. I really do support it. I do live in a community in California, which we refer to it as the missed opportunity zone. And the way that this program was rolled out, when it got to the state level and then to the local level, then it was very haphazard and very quickly had to decide on the locations and the census tracts. And so the challenge is that we felt that there was only one bite at the apple, and therefore we had to designate those properties. When it was realized that we really missed out on better properties because we didn't feel we were going to be competitive, then we were told that in 10 years you may be able to change that. So I think that's one of the things to look at is, as you're looking at the last tranche, is there an opportunity to take an area that has been designated, maybe undesignated, move to another location? An example of that is I have right now $6 billion of projects that are ready for financing and development permitted, and they are now in competition with other areas because they're not in opportunity zones. And so that's a real challenge, and I think that slight change to give us that opportunity, I think, would help out quite a bit. And but once again, it is a great program. It's I worked a lot with new market tax credits. It was a great program. This is 10 times better. It's easier, it's less expensive, and it's really going to put the money where it needs to go, reduce the cost of doing business. And I agree with everything that this panel has said, but that is one thing to take into consideration. We're having that discussion at the state level in California, where the 58 counties have come together and said we kind of missed out on the way that we haphazardly put our properties in. And are we going to be able to go back to the well and maybe reconsider the real estate?
Yeah.
I can answer that one. It's not the greatest answer. It's you're not the only person that's ever come and of course had that concern and that complaint, because a lot of people, I don't think, understood exactly what this legislation was. What is the power behind it when they're designating? It is locked in statute. It'd have to be a conversation we'd have with Congress to change those designations to open that back up. Of course, you can imagine also the community that you pull away a designation from and give it to another one, you're going to have some concerns there. I think there's going to be a lot of potential animosity. So it's not out of the question. It is just a higher threshold. It's not something that we can do through regulation. But I would say, on on that point of where the designation was, one of the things that we wanted to do is, of course, allow the states to designate. We actually do see that as a strength. We didn't want the Department of Treasury or the IRS or anybody in the White House to be picking out what communities, what census tracts all across the country should be designated. So we did give that to the states to enable the states to actually come forward. And every state had a different way of doing it. Some of them sat down. Alabama was particularly good at sitting down with the communities and helping to identify and strategize where they're putting their zones. Some did it more haphazardly. I'm really sorry to hear that was the case out in California. But I think really now, the places are designated. Those communities will benefit, and we should do the best we can to make sure that it's successful in the communities that have been designated, so we can have a much easier conversation with Congress as we move forward if we want to expand or move designations.
Yeah,
So-
I'm sorry. And can I add really quickly, just to commiserate with you, you guys had a 2-week public input process in California. So yes, it was a rapid turnaround time. What I would be most concerned about in California is your modified conformity and what you guys are looking at for conformity at the state level. And so I'm bringing that up just in general because it's another consideration around this is a federal benefit. How is the state treating its capital gains? Will you get the same benefit on your state capital gains? Most states have conformed. California is one of the ones that hasn't fully conformed, and they're considering modified conformity. That makes this really complex for investors to get their heads around because it adds additional layers of complexity that because this is a competitive program, so every census tract is competing with every other census tract for investment, it really puts California at a disadvantage, I think.
So we have about 4 more minutes. So I want to take 2 questions, answer them very quickly, and I want to give everybody an opportunity to close. So go ahead.
Okay, you've talked a lot about domestic investors in opportunity funds, opportunity zones. How complex or simple would it be for foreign investors to get involved, and would they be eligible for the same benefits that domestic investors would? I'm thinking in particular of a Nigerian investor who was unable to be here, who is very interested in this.
Yeah, so the benefit is on U.S. tax liability. So you would just have to have tax liability here in the States. And then the Opportunity Fund would have to be organized in one of the 50 states, D.C., or the U.S. territories. Other than that, those are sort of the 2 threshold questions.
Yeah, I mean, and that's why I brought up too as well. This can be if you're an investor and you have property in the United States and you sell that property, or if you have stocks in the United States, if you have bonds in the United States, business, anything that would trigger a capital gains tax, here in the United States for somebody who owns that property that might live in London, that will qualify. That investor that's living in Nigeria, if they sell, property in Alabama, that would trigger capital gains liability. They can roll that into an investment in New Orleans, for example.
Yeah, I guess what you're saying is there's no benefit for a direct investment in the fund, that it would have to be predicated on a prior U.S.-based investment or a transaction which triggers capital gains tax liability. Right. That's what I hear.
Yeah.
All right, so I'm going to give each of you 30 seconds to either leave the audience with some action they can take, because I hate coming to forums and listening to people talk, and then you leave like, so what? Or just a words of wisdom on how to navigate through this new territory. I'll start with you, Marc. You have the mic. So
Henry
go ahead.
Childs, you're a great American. Thank you. The only thing I'll say is just to reiterate, in 30 seconds, this is all about trying to build public, private, nonprofit partnerships at the local level to get the projects right. I'm confident that the investor community will figure out how to create funds and incentivize money into this. I think creating the effective and proper deal flow that communities want and that benefit communities, I think is where we have to build the right muscle memory, the right infrastructure, the right sets of relationships. So look forward to more discussions on this, and thanks for having me on the panel today.
Ben?
I would just say this is big time. You've heard a lot of the numbers. There's a lot of investors sitting right outside the pool waiting for those first deals to pop. But when they start popping, it's going to roll really fast. And so I'd encourage everybody in this room, take a look, take an assessment of your potential tax liabilities in the United States that some of your investors might have and how they can take advantage of this, because they're going to be looking. And then I think, as both of our other panelists said, these are going to be the hot zones as well. You don't have to, of course, take advantage of opportunity zone tax incentive to invest in our opportunity zones, in our distressed communities. This is where a lot of capital is going to be flowing. So this is a huge opportunity, whether you're domestic or foreign.
If you need more information, our website is eig.org, so economicinnovationgroup.org, including the map.
All right, thank you for coming in. I just want to hold on, I'm closing.
Oh.
I get 30 seconds, all right? I just want to reiterate, like, there are billion-dollar funds being created as we speak. Do not miss out on this opportunity. Even if you're not an investor, lend your voice to this. Each one of you represents a community. This should be something that we all join together on. This is one of those legislation pieces where, Americans come together and actually do some good. So get involved. Treasury has a good website. Economic Innovation Group has a great website. Marc is traveling around the country, but his people can get a hold of him. And we just thank you for coming, and goodbye.